Hello and welcome to The Explainer, brought to you by the ViewPoint. We're getting right into it today, breaking down the new Income Tax Act 2025 and exactly how it impacts your virtual digital assets. We are going to take this at a nice, slow, deliberate pace, because understanding these rules in simplified language is absolutely crucial for protecting your hard-earned wealth. Let's get started. So did the government finally give us a break and reduce that brutal 30% crypto tax? I know this is literally the burning question on the mind of every investor in India right now. The new act officially came into force from the 1st of April 2026, and honestly, the confusion out there is at its peak. Everyone is looking for some kind of relief. So let's get you a definitive reality check, based strictly on the official text.
Here is our quick agenda for today. We're covering the new act reality check, what exactly a VDA is, that infamous 30% rule, crypto versus equity, busting 6 costly tax myths, and wrapping up with legitimate tax planning strategies.
All right, Section 1, the new act, reality check. Let's look at the old 2022 rules versus the new 2025 landscape.
And well, here is the hard truth. Looking at the side-by-side comparison, you can see that substantively, absolutely nothing has changed. The stringent rules are completely identical. The tax rate, still a flat 30%. Deductions, only your cost of acquisition is allowed. Loss set-off, still a big no. They essentially just lifted the rules from the old Section 115 BBH and moved them under a new section number, Section 194. There is zero new relief here. Moving right along to Section 2. What exactly is a VDA? Let's check out the Section 2111 definition to see what actually falls into this tax net. The government made this definition incredibly expansive on purpose to catch, well, basically everything. Whether it's Bitcoin, Ethereum, Solana, or even gaming and digital art NFTs on the blockchain, it's all strictly covered. The wording is designed to leave zero loopholes. There is no exclusion for small amounts, and there's definitely no exclusion if you're just a hobbyist. If you hold it, you fall right into this net. Okay, Section 3, and this is the absolute core of the issue, the 30% rule inside Section 194. Take a moment to digest this official text. Section 194, Table Serial Number 4, leaves absolutely no room for interpretation. It mandates that any person must pay 30%. There's no special category of taxpayer that gets a pass here. Salaried, business owner, NRI, it doesn't matter, you pay 30%. And it explicitly states that no set-off of loss is allowed whatsoever. Now here is a massive trap you need to be aware of. The word transfer isn't just about selling your crypto for Indian rupees. Swapping your Ethereum for Bitcoin, that is a transfer. Gifting crypto, transfer. Using it to buy a cup of coffee, transfer. All of these trigger a taxable event under the law. And regarding deductions, the law is completely unforgiving. You can only deduct what you originally paid, your actual cost of acquisition. That means your exchange transaction fees? Nope. Gas fees on the blockchain? Ignored. Internet charges, mining expenses? Totally useless for tax purposes. You cannot deduct a single rupee of these from your profits.
Let's pivot to Section 4, crypto versus equity, because treating your crypto portfolio like your stock portfolio is a one-way ticket to a very costly tax notice.
The most shocking difference here is the holding period. If you hold an equity stock for 24 months, your tax drops significantly to 12.5% for long-term capital gains. But if you hold Bitcoin for 24 years, you are still paying a flat 30%. Crypto has zero long-term capital gains benefit. It has no 1.25 lakh rupee exemption and no loss set-off. They are entirely different worlds.
Let's run through a real calculation scenario to make this concrete, the crypto-to-crypto swap.
This is easily the most missed taxable event in India, so follow this math with me. Step 1, you buy Ethereum for 1 lakh rupees. Step 2, the value pumps to 2 lakhs and you swap all of it for Bitcoin. Now pay close attention to Step 3. Because a swap is legally a transfer,
Boom, you just triggered a taxable event on that 1 lakh profit. Even though no rupees ever touched your bank account, step 4 means you owe 30,000 rupees in tax plus the 1% TDS the exchange already deducted. All right, section 5, 6 costly tax myths. It's time to look at what people think versus the actual truth. Let's rapid fire bust these myths right now because they are tricking investors out of lakhs of rupees. Think long-term holding saves tax? False. It's always 30%. Can a crypto loss reduce your salary tax? Absolutely false. Section 194 bars that. Crypto to crypto swaps are tax-free? False. We just learned it's a taxable transfer. Does the 12 lakh rupee zero tax rebate cover crypto? False again. Crypto is taxed completely separately. Are transaction fees deductible? False. And finally, are crypto gifts from friends tax-free? False. They are fully taxable if they are above 50,000 rupees. Guys, ignoring the rules just won't save you money. And here is the real kicker. Section 393 of the new act mandates a 1% TDS on transfers over 10,000 rupees. And guess what? That TDS shows up directly in your annual information statement. The income tax department can see every single mismatch. If you forget to declare your crypto income, but that TDS is sitting right there in your AIS, you will get caught. Always declare it. Finally, Section 6, legitimate tax planning strategies. Given these harsh restrictions, let's look at how you can actually stay legally compliant.
It's tough, but you do have legal options to empower yourself. You can gift crypto within your immediate family, like to a spouse, under Section 92.3. That neat little provision avoids the immediate gift tax, though remember, the 30% still applies when they eventually sell. Secondly, keep incredibly detailed records of your acquisition costs using FIFO or weighted average. Never guess these numbers. Third, always claim that 1% TDS credit in your ITR, as it substantially reduces your net tax payable. And honestly, just consult a virtual CA to make sure you have it perfectly locked down.
Thanks for watching video. Share it to whom it may need it. Subscribe to the ViewPoint for more informational video in simplified plain English. Drop one comment. Do you hold crypto? I read every comment. This is the ViewPoint.